Good morning, ma. Can you hear me?
Yes, yes, yes. I can hear you.
Okay. Thank you so much, ma, for joining.
Okay, so you can hear me now. You have unmuted me. I was having problems this morning with this system. I've never had this problem trying to get in before. I was asking me all kinds of crazy stuff on my cell phone. On my computer now is telling me Zoom is not responding. Anyway, finally I was able to get in on the cell phone now, so I'm going to just use my cell phone.
Okay,
So you
okay.
have I've been practicing and practicing and practicing to make it fast because I'm trying to put it inside 10 minutes, but it's jumping to 15 to 20.
Okay,
I
but
hope I can.
that won't be a problem. That won't be a problem. Let's just
Okay.
wait
And I
till
just use that.
12 noon.
Mhm.
Let's just wait till 12 noon. Then I think we can formally start. I think I've shared the link to like everyone I know.
Okay. And I have, what was I going to say? I just looked at the price of gold now so I can update my part. Do you need me to give you any of that for your part? Because I have the prices for this morning, the COMEX, the sports, and the LBMA.
No. Since my own slide is going to be very short, I'm trying to wrap up my own slide in like 25 minutes so that I can give you the time to actually make your speech so that
Okay.
everyone,
Okay.
all of us will be
Because I
done.
thought, okay, explain this to me. The notes that are there, and there are two notes. One is the global economic outlook, and the other one is the opportunity. Or everything is one.
Um, I think
If everything is
everything.
one, it can't be 10 minutes, like your boss said. How can the whole thing be 10 minutes? That part of the global economic, I'm trying to make it like 15 minutes. The other part is not. So I
So
don't
yeah,
know.
I was even asking like, which slide do you want me to first start with? Like, because I know I'm sharing screen, so it
No,
depends
no.
on what
But
you
what
want to
I'm
talk about
saying is,
first.
I'm doing the global economic outlook. Aren't you doing the opportunity?
I'm doing the opportunity cost. That's why this
So the
presentation is
global
here.
economic outlook is where you're going to start with me, where it says the slide that says global economic outlook. There are about four, there are only four because although I'm going to be talking for long, but I've put them into four slides. So that's the first slide. Have you seen it? After Dukia Gold, master something. You know, it starts with Dukia Gold, first page. Second slide is a Dukia Gold master something. The next slide is the global economic outlook and gold performance, under which you have introduction, the effects of the uh, World War II and the bailout of nations, and then the advent of e-banking.
Yeah, I've
Have
seen
you
the
seen it?
slide. I've seen the slide.
Okay, so after that slide comes the country economic risk assessment slide with all the nations. And then after that comes Nigeria continued, where
Yeah.
you have its conclusion. So those are my slides. I'll be telling you, the first one I'll say, you know, it's like I always hear people telling you. Next slide, please. Uh-huh.
No problem.
I'm following,
That won't
I'm
be a problem. That
following,
won't be a problem.
yeah, I'm following what I have heard. And I've been practicing and practicing. I thought I'll be able to practice one last time today, this morning, but it doesn't seem so. I have to go to the bathroom. Because if I talk, you would hear me.
Yeah, just calm down. It's not going to be that much of a big deal. Just calm down and make the presentation. It will work.
I know. You say calm down. You know, this is not, it's because you didn't give me a lot of notice. You know, the notes and everything just came a few days ago. So it's like, yesterday was when I started really doing the practice. In the night, I think I slept for 2 hours tonight, overnight,
Wow, wow, wow.
So trying to bring it down, so that I'm not talking too fast, so that people do not get what I'm saying. And I'm not talking too slowly, so that it drags forever. So
Okay.
that's something you have to, when you practice, the more you practice, the shorter it gets, because then you have more of the command of, you're not really looking down to look at anyway, nobody's going to see me. They won't know I'm looking down. So I have the slides with me, so that I've written it on, on it. So I'm just going to be telling you, or else before, normally, if you had given me enough time, I wouldn't even be using the slide at all, because I would know it by heart. but I don't. So I have to use. That's why I say I need my two hands because
Okay.
with the lack of
Um,
notice, it's just fire on the mountain. Okay.
all right, all right.
Okay. So, but I trust you to you are there, so you'll be helping me. So I know I don't have any problems.
Definitely, definitely, definitely.
Okay. So let me just go through quietly now. This time, I'm going to go to the bathroom to go and because you probably will start before I come back here. I
Yes.
want to do the last practice. I'm going off to the bathroom. So if you want me, okay, I'll take because if I talk, you would hear because you have unmuted me. Or are you going to mute me back and then unmute me later?
Um, I may not mute you, but in case I start hearing background noise, I may just mute everyone, but I will unmute you or something.
Oh, okay. Because I want to go to the bathroom. I want to go and do it in the bathroom, which is not near where the so. But if you screen, what I'm going to do is and put it not too far away from me. So if you need me, just make sure
Yeah, yeah.
that
I'll notify you. You know, you know.
you screen into the microphone so I can hear.
Okay, no problem. Not be a
Okay.
problem.
Mhm.
All right. Good morning, good afternoon, good everyone. Good evening, everyone. Welcome to the Dukia Wealth Management Seminar for October 2025. It's already 12 o'clock and we'll begin in earnest. But if I may beg your crave your indulgence, you can please share the link to this webinar to your friends and family. Anyone you know that wanted to learn about gold or how gold investing works, you can please share the link to everyone that you know so that they can be a part of the session. We'll give just a couple of minutes for everyone to actually join in. Then we'll kickstart in earnest. Thank you so much.
Call him, Mama will be calling. Don't you have units? Yeah. Oh, okay. I don't know. I feel like you go like doing it. Okay. I don't know whether I can just call him. Whether I still around. Yeah, I don't just call him and stuff. He goes for email. Well, I got like reply. Just
All right. Good afternoon. Good morning, good evening from wherever you're joining from. My name is Emmanuel. I work for Dukia Gold, and I'll be taking you through this presentation. As you would have known in time past, we normally do a seminar at the last Thursday of every month, just teaching people about investment grade gold and guiding them on how to show benefits in the market. But the way we've always done this is that only one person, which I am, will only talk about the investment benefits. We'll take questions and answers. You will have feedback from the management, and we'll just give you perspective on what to do. Concerning that, we'll be having another speaker joining us. So I'll wrap up my presentation in due time. And Mrs. Ijose will join us to actually give perspective to this particular topic. Thank you so much for joining us. I can see most of our customers, our investors, definitely on the call. And I'll be making this presentation as brief as possible. Thank you so much. Now, you're welcome to the Dukia Wealth Management Seminar. Now, the topic for this seminar is the opportunity cost of holding gold as an investment asset, meaning that, we are giving you perspective on why do you need to hold gold and what are the benefits you stand to lose in case you are not holding gold. What are the benefits you stand to lose if you are holding other asset classes like real estate, like bonds, stocks, or commodities, as opposed to gold? And what perspective do you have when you are actually selecting your investment assets and building up a viable and trustworthy investment portfolio? As you know, some of the statements I'm going to make here are going to be guided by a disclaimer. Now, that doesn't mean that they are not actually backed by research, but this actually implies that most of the statements I'll be making are forward-looking, and meaning that you have to consult your investment advisor before you actually take an investment decision. Okay, who is Dukia Gold? The managing director is directly on the call. The chairman will be joining us, and we have a host of other directors, apart from the ones listed in your screen, to give you perspective about who we are and what we do. So what am I going to be talking about? I'm going to give you the aims and objectives of this presentation. That means what are the benefits you stand to lose if you're not holding gold as part of your investment assets. I'm going to be defining what opportunity cost mean, choosing between yield-bearing assets and store of value assets. So there are various kinds of asset classes you should have, and what is the dilemma that investors face in choosing between yield-bearing assets and store of value assets. I'm going to give you a perspective of how gold fits into a balanced portfolio. I'm going to give you why all this matters in Nigeria, considering the interest rates and inflation and every other economic uncertainty that's happened in Nigeria. Third, I'm going to give you the definition of a comparison of gold with other asset classes, how gold differs from stocks and bonds, how gold differs from real estate, from your favorite cryptocurrency, and what are the chances you stand to miss if you're holding all these asset classes, stocks, bonds, real estate, but you are not actually holding gold. Next, I'm going to give you the true cost of not holding gold. Now, what is the real cost of not holding gold as part of your investment portfolio? Then I'm going to give you a perspective of how you can actually integrate gold into your investment portfolio and give you a viable alternative of how you can do that. How you can plan your investment assets using dollar cost averaging, and how gold perfectly fits as a crisis protection versus a generational asset. I'm going to be inviting the chairman, he's already on the call, to actually give perspective to the welcome address, if you don't mind. Chairman, sir, you have the floor.
Thank you very much, Emmanuel. Once again, I welcome all of us stakeholders in the gold investment industry and club. We welcome you as special Dukia customers. I would first start by saying that we are entering very interesting times in the history of mankind, and especially in the history of how money behaves. One thing I would say to each and every one of us is that the world is full of obvious things, just like Sherlock Holmes says, but not everybody pays attention. What I would ask is that this is the time to pay attention to investment. This is the time to pay attention to your investment portfolio. This is the time when you must remember that putting aside money for the rainy day matters. This is the time when you must again be the genius who can do everything or most things that every and anybody else can do, but you must be able to do it smart. You must be able to do it in a way that guarantees that when all is said and done, you will have enough for tomorrow as well as have just about enough for today. You can't afford to consume everything because too many things are choppy. Yesterday, the Americans cut the interest rate, which is fantastic. Nigeria is also doing the same, but inflation remains elevated. And once you have inflation that is higher than the interest rate, what happens is that money must switch from that economy into where it can make more money so that you earn more interest than you actually currently earn on what I call your rate of return to be positive. The second thing that is very obvious that is happening is that even though interest rate is being lowered and inflation is still remaining elevated, there are too many uncertainties surrounding what you and I continue to refer to the trade war. The Americans have not let up, the Chinese are ramping up, the Japanese are making it sound impossible also at this time. So we are in a new world, a very new world, and WTO is recalibrating. We have one of our own, Okonjo-Iweala, there. The future price of commodities will be very choppy. But one thing is certain, your friend gold, your preferred investment gold, will continue to hold its own. And therefore, today we will be speaking to you about the opportunity cost of holding gold as an investment asset class. That opportunity cost is obvious. It's good. It's extremely good. And I think it will remain extremely elevated in the short run. We predicted at the beginning of this year that we think that gold would get to 4,000. Indeed, it has gotten to 4,000. There's been some profit taking. I think, yes, that's necessary so that everybody can test it. But it's been tested, it's remained elevated above 3,839. We think that is the beginning of a new round of buying, especially given the elevated risks that would come from the lowering of interest rates across the world, and unfortunately, the elevation of risks related to inflation. If that is going to happen, I would also tell you that there's a second reason why gold and precious metals would also remain elevated. Prior to now, jewelry, electronic industry was elevated, but unfortunately, because some big countries are moving away from arms and armament, the military industrial complex, that's what they call it, MIC, is also going to put in quite a bit of bids to buy precious metals, especially silver and gold at this time. And therefore, don't be surprised. There's a 350-ton minimum demand per annum coming the way of gold in one or two countries, and it can be multiples of that in most of the countries that there is. So, what am I trying to say? The law of demand and supply will still take place. There's bound to be more demand for gold than there is current supply of gold. Even though yours truly, Dukia Gold, is happy to announce that by the special grace of God, January this year, coming, which is 2026, we would announce to you the first full production of a gold bar from our backward integration program. It will be a major game changer for us. It will be a major game changer also for you. And my hope and belief is that as we ramp up for production, I will beg all Nigerians who know what it is to please also ramp up in buying gold. You would be glad you did. I think from what we see from the projections from the people who are very, very informed, the opportunity to take gold up to 4,000, 5,000 now exists. And we will see how it plays out. And when it does, it will also be the better for it. I would say one more thing though. Gold purchase is not for precautionary investors. Gold purchase is like buying a house in Ikoyi. You don't want to sell it tomorrow. You want to keep it as part of your ground norm, the most important asset you have, because that's what they call the family loan. That's where you put that kind of money. So when I see a few of us trying to take speculative opportunities on gold, it's welcome, it's necessary. However, my understanding is if you truly need to make life comfortable in the short and on the long run, please consider gold as an asset class for the future benefit of your family and children and yourself. It's the kind of place where you say, put away what you don't need immediately, and you're sure it's only for, it's like they say, bottom pot. That's what gold is to be in your portfolio. There is somebody who's always been very averse to gold. He's called Demon, and he's a very, very powerful person in the finance industry. To the extent that he has made up his mind now that every American should put at least 25% of their portfolio in gold, it must tell you that something has shifted materially. He doesn't talk flippantly, he doesn't make any noise whatsoever. If he made that kind of advice, and I've read it in blue and black and white print, I would only say that let me end today's conversation by saying, welcome to the future of gold, and welcome again to an elevated demand for gold. And I'll leave my two guests at today's meeting to do justice to it. We'll be having Emmanuel, and then we'll be having Tutu. Tutu is joining us as part of our mode of diversifying away from internal research to speak to you. We are engaging her on this first maiden collaborative effort of having other experts speak to us. Adetutu spent most of her life as a merchant banker in Nigeria. She then traded as a chartered accountant, merchant banker, finance expert in the United States of America. And it will be a pleasure for us to have her speak to us for about 10, 15, 20 minutes today. I'll pass the microphone now to Emmanuel to start the presentation. Once again, I'm extremely grateful. Thank you, everyone. God bless you mightily. And God give us all a joyful day as we meet at this important event. Good morning and good afternoon, wherever you may be. Life is good. Thank you very much. Bye-bye.
Thank you so much, sir, for that beautiful welcome address. Now we'll kickstart with the presentation in earnest. In a special way, we want to appreciate the Managing Director, Ms. Bosede Olabi. She's directly on the call, but she would actually be listening and following through. Okay, what is opportunity cost? Now, the opportunity cost represents the alternative when the desirable benefits that someone forgoes by choosing one alternative over another. What this means is that the benefits that you lose from an option you failed to choose is called the opportunity cost. So an opportunity cost is more than just a financial metric. It's actually used for strategic planning. It's not actually a cost that you actually write on your balance sheet. It's not reflected in your financial reporting accounts, but it's just a cost you use to plan against choosing various forms of investments. Like if I have 1,000 naira, for instance, and I choose to take to go and watch a film with 1,000 naira, rather than buying a shoe of 500 naira. That shoe, the worth of that shoe would actually be the opportunity cost forgone instead of watching the film. I'll give you more examples. Now, using this pictorial diagram, if you have $100 with you and you spend it on a shoe, instead of investing it at 5% interest rates, that $5 that you would have earned investing it at 5% interest rates means that that is the opportunity cost of that investment. So it is the kind of return of benefit that you lose over picking one option over another option. And it's basic economics. It's something that we do like every time. If you go to the market, you may choose to buy pepper and salt instead of seasoning. You may choose to buy tomatoes instead of pepper. You may choose to buy potatoes instead of yam. So all the benefits that you lose by picking one option over another is called the opportunity cost of that investment decision. Now, corporations regularly use opportunity cost in deciding how to use their money, such as buying, by investing in new products versus upgrading old equipment. And you can use opportunity cost definitely to calculate the full cost of your decisions, whether you're deciding how to spend your money or how to spend your time. So opportunity cost is not solely a financial decision, but the calculation is best used when comparing uses for the same resource, such as money and time. Now, investors constantly face a trade-off between assets that generate yield and those that provide value. In my time at Dukia Gold, most people ask me, okay, but gold is not actually paying us dividends, quote and unquote. That why should we keep investing in gold when we have like equities, shares, or real estate that pays on dividends? But the function of, even though that gold does not pay interest or dividends, but their value actually appreciates based on the price, it performs a unique function against like a hedge against inflation, currency depreciation, and systemic shocks. All the various asset classes, bonds, real estate, equities, stocks, and shares, all these various asset classes also move against the currency depreciation. They also have their own systemic shocks. In good times, yield assets may actually perform, but in crisis, we all know that gold actually balances over time against inflation and currency depreciation. So the challenge is not one of the other. You don't have to make an investment decision by investing most of your assets into equities, into bonds or real estate. The rational approach is diversification by combining productive assets, assets that provide you yield, than assets that provides you value. And this is the investment decision you need to take home with. That is not about choosing one or the other, but about choosing gold to better hedge your investment portfolio. The real opportunity cost is not even the gold you buy, but is the gold you fail to buy. We know that currently in Nigeria, the core inflation rate is 19.53% by the central bank, and owning gold in Nigeria serves as the financial life raft. We've seen the central banks all around the world doing the same thing. They are increasing their gold reserves. We've seen institutional investors increasing their gold reserves. If banks are actually doing the same thing and increasing their gold reserves, how much more you as an individual, you need to actually take a closer look at your investment portfolio and begin to diversify the assets. That actually gives you a sort of hedge against inflation and actually preserves the value for you and your family over time. Now, most people, I grew up with this investment playbook, the old investment playbook, that if you want to actually invest, you do 60% of your investment in stocks and 40% of your investment in bonds. That was the playbook we all taught while in secondary school economics, in secondary school business studies, and most of all the courses I actually did. We are just focused on stocks and bonds. But the reality of today's economies, we've seen the Trump tariffs, we've seen the inflation rates, we've seen various government agencies, we've seen the crisis all around the Middle East and various countries, Russia-Ukraine war. And this approach, investing 60% of your investment in stocks, then the remaining 40% in bonds, will not actually get you better value for your money. The best approach is to have a safe haven, which is gold, about 15 to 30%. You should invest in commodities. You should invest in bonds about 15%. And you should actually reduce the amount of stocks that you actually play with. This approach, instead of the old model of 60-40, this approach is a better gain on your investment portfolio than this on my left. The approach with this is that if you are choosing solely stocks and bonds to invest, you are actually going to be subject to the financial uncertainty. You're actually going to be subject to the currency depreciation. Even if all your stocks and bonds are in Naira, you're going to be subject to the inflation rates. And the value that you actually get from these assets will not actually give you a better return for your money. By diversifying in safe haven assets like gold, you actually get a better value for your investment portfolio. Now, okay, we'll now do like a comparison of gold versus other asset classes. How does gold relate versus to shares, versus to bonds, versus to real estate, and versus to other asset classes? Now, the first thing is that gold actually provides a steady returns over the long term, solely relying on price appreciation. But equities like stocks will receive potential long-term returns through capital growth and dividends. So for equities and stocks, they normally give you dividends at the end of every month, whether they choose to do it or not. But you should now know that gold historically outperforms stocks. You can look at the price chart of gold and you see, as comparison with stocks, it will actually outperform and do better. Now, gold is generally less volatile and acts as a safe haven during market crashes. But stocks is very, very highly sensitive to market cycles. If you can remember the time where the United States government, Donald Trump and Elon Musk were fighting, you can see the price of Tesla shares actually drop dramatically. So this means that every stock you have is highly sensitive to market cycles and economic conditions. But gold is not systemic to the decrease of a federal government. It's not systemic to the decrease of a central bank or the inflation rate of your currency. Gold is generally acts as a safe haven beyond all these crashes. Now, the diversification, gold has a negative or low correlation with stocks, meaning that its price often moves independently. Now, with stocks, it remove, if the economy is performing well, you would watch your stocks go up. If the economy is performing badly, you watch your stocks go down. And even if the economy is performing well, if the company is not actually generating the best leadership, if the company is having trouble economically, even if the economy is performing well, that value of that stock will still go down. But gold doesn't have a correlation with stocks. It doesn't move dependent of a company's balance sheet or a company's leadership or a company's growth trajectory. And we all know gold does not actually generate income like dividends, but stocks actually do. And the best approach you can take is actually diversifying your investment portfolio. The next is gold versus bonds. And you should know that bonds means debt, where a company takes a part of your money and based on a fixed interest rate, they will agree to actually pay you back that money at the end of a particular amount of time. the Nigerian government actually issues bonds. We've heard about this, like Sukuk bonds, and even corporate entities. You can see during the recent recapitalization of banks, you can see that most banks are actually offering people to come buy shares and taking people's money with a fixed interest rate. Those are just the general approach to bonds. But unlike gold, the returns are solely based on price appreciation, while bonds is based on a fixed interest rate. Whether the government or the company issuing out the bonds will decide on the interest rate they will agree to pay you. The risk of gold is that it does not have a counterparty risk. So the risk of bonds is that if you're buying government bonds, like the Nigerian government or the US government, they will not be far liable to default on their credits. But a company can default. We've seen companies go bust. Even though banks are actually issuing bonds, we've seen like an example of Heritage Bank that actually went closed. So bond is typically less volatile, but it depends on the creditworthiness of the issuer to actually make the bonds financially guaranteed. Now, inflation protection, gold is traditional hedge against inflation. Has the value often increases as currency decreases, but bonds is offered a very limited inflation protection. During last year, the price of Nigerian bonds by the Debt Management Office was around 17%. And you could see last year, the inflation rate was around 30-something%. To show you that even though they are giving you far more interest and the bonds they collected from you, comparing that with the inflation rate, the bonds were actually far less worth their while. And the correlation is gold tends to move independently of bonds and stocks, which is very useful for diversification. But bonds is just subject to their issuers, either a government or a corporate body. If they can agree to pay you, they will pay. If they can't agree to pay you, they will default, and you will need far higher authority to get them back. Now, gold versus real estate. Now, gold is highly very liquid and can be bought and sold almost at an instance. But real estate is very, very illiquid. If you know the time taken to actually buy a house in Nigeria, you're going to take even far much more amount of time to actually sell that house, even if you're selling it at an instance. While gold doesn't actually produce rental income, real estate can actually generate passive income through rental yields, depending on the economic situations. Now, the gold can experience short-term price fluctuations, but is generally seen as stable. Real estate can vary with value depending on location and demand. So because you bought a house doesn't mean it's actually valuable. The value of that house depends on the demand and its location for it to actually perform better. Now, gold is actually used as a primary tool for wealth preservation, especially in uncertain times, while this real estate offers both wealth preservation and creation through the rental income. And one of the most important parts of gold is that you don't have to maintain it. It has far lower maintenance costs. You don't have to refurbish the gold, pet the gold, caress the gold, or do anything with it. Once you buy it and it's stored in a vault, it is there. But for real estate, you have to involve very significant maintenance and management costs. You should all know that with your houses, even after like the first 5 years, you will need to maybe replace the lights, you will need to maybe replace the water handles, the water taps, and various other commodities in that house. So real estate comes with very significant maintenance costs, but gold, once you bought it, you bought it. Now, the rest of gold with other commodities. Now, you should know that gold is not actually the only commodity you can buy or sell. You can buy oil, you can buy wheat, you can buy copper, even rice. These are other commodities as traded with gold. But other commodities is primarily driven by supply and demand for industrial use. If there's far more demand for rice, as there will be during the Christmas season, the price can go up. If there's less demand for rice, the price could go down. So it's primarily driven by supply and demand. Gold doesn't experience the cyclical movements like other commodities like oil or copper or wheat. So gold is fairly stable. And gold has historical reputation as an inflation yield. Most people don't actually trust something like rice to hedge against inflation. It actually turns to gold. So historical reputation mandates that gold would better perform other commodities used in hedging your portfolio. Also, gold is considered as a defensive safe haven asset and very performs well during uncertainty. While other commodities maybe can be a diversification tool, but it's generally more volatile and less consistent than gold. So with all these commodities that I showed you, from stocks, bonds, shares, and even oil, even real estate, you have to now carefully now plan your investments to better secure your future and the life of your children. Now, if you are in your 30s, your 40s, and you actually begin to get a consistent amount of money, you should choose better investment that will give you far better return on your value. I'm not saying stocks or shares are bad, no, but considering the economic uncertainty that we face today, those shares, putting most of your money in those shares will not give you a far better return of your money. Even if all your shares are actually in dollars, which is the universal currency of today, it won't actually generate the kind of return that you think it will 40 or 50 years ago. The best approach you can use now is actually diversifying your investment portfolio and giving far more value to your worth as opposed to before. And what is the true cost of not holding gold? The true cost of not holding gold lies in the steady and invisible erosion of wealth that comes from inflation. So, as I said earlier in the previous presentation, the real cost is not the gold you buy, it's the gold you don't buy with your money. Because inflation and currency depreciation will actually affect every asset class you buy, apart from gold. In Nigeria, where inflation surpasses 19% and the naira continues to weaken, savings kept in cash or traditional deposits rule these value over time. Gold, on the other hand, retains its purchasing power because it's not tied to any government or central bank policy. Unlike paper money, which can be printed in unlimited quantities, gold's scarcity and universal acceptance make it a reliable store of value in both local and global markets. Globally, investors, central banks, and governments recognize gold's stabilizing role. In the United States and Europe, gold acts as a hedge against market downturns and monetary policy risks, while in Asia, it's just a cultural and financial anchor. So this global behavior underscores one truth, that gold is not a speculative asset, but a very strategic insurance policy against systemic shocks. And for you in Nigeria, it actually gives you a good sense of where to actually put your money in. The impact of the impact of not owning gold in Nigeria is even more profound. You have the foreign exchange scarcity, we have the rising inflation, we have the declining savings yields have left investors with a limited safe options. The naira's instability and erosion of real savings make gold ownership not just a choice, but a necessity. Those who hold gold, especially through secure LBM standard platforms like Dukia Gold, gain the ability to preserve value, convert to naira instantly, and participate in a globally recognized asset class. So as I said, the impact of not owning gold in Nigeria is more profound, showing you that if you actually keep most of your money in stocks and bonds, you are actually going to lose real value over time. It's not going to be a fate something, it's a statement of fact, because comparing the inflation rate with the returns that are getting on your stocks and your bonds, even your real estate will not actually match what you are actually spending money on. So you need to take a closer look at your investment portfolio, as the chairman has rightly put, and give yourself the opportunity to earn far more money than you would have ever earned by investing in gold. And how can you do it? If you want to take this leap of faith to actually open your investment portfolio to added returns and added benefits, how do you actually go about this? You need to plan a strategy first. You can either do a short-term or a long-term strategy. But as we have always noted, people who do short-term strategies always fail in the meantime. If you notice during the past week, gold actually, let me say the past 2 weeks, gold actually climbed to over $4,000. When it came down to about $3,900, I got a lot of calls from people asking me, oh, the gold price is falling, this is happening, that is happening. And I said, it's not a thing of fact that you should be worried about. You should know that at the end of we actually thought that gold will hit $4,000 at the end of the year. But it hit $4,000 way before that, months before that. So it's not a speculative investment that you can use and capitalize on price fluctuations to make money. It's a hedge against inflation. So we don't actually recommend putting your short-term funds in gold. We actually recommend putting funds that are going to keep and build wealth over a long period of time. Second, you can use dollar cost averaging. We have automated Dukia Gold platform where you can actually purchase gold at fixed intervals, regardless of the price, allowing you to smooth out the cost over time. So if you take it has a thing of motive that every week I'm going to buy 5,000 naira worth of gold. You can actually automate that with the Dukia Gold platform, and every week it just automatically dissolves 5,000 naira of gold. Over the course of time, at the period of even 1 year or 2 years, you will better perform the person that is buying and taking price fluctuations to actually manage the investment portfolio. If you allocate 5,000 naira each month for gold purchases, you automatically buy more gold when prices are lower and less when prices are higher. Over time, the average cost of your gold holdings will be balanced, helping you to build wealth steadily. And this is what I actually recommend to people that reach out to me. If you are starting to invest, practice dollar cost averaging, automate it with the platform. It's going to be stress-free. You don't have to be constantly looking worried about price fluctuations, because you know that when the prices are lower, you buy more. And when the prices are higher, you definitely buy less. Okay, you can align gold purchases with financial milestones. You can actually begin to save for buying a home, paying for college, or planning for retirement with gold. So if you want to buy a house in 10 years, you can accumulate gold over time to sell some of it when you need a large sum of money for a down payment. So using the platform, it has actually made you easier to actually automate and align your gold purchases with financial milestones. You can do gold for gifting. You can actually set a goal of buying 10 ounces of gold in 5 years to pay for college. And this actually increases its value. And when the time comes, you can actually get far more return on your value than keeping it in stocks or bonds. Definitely, you should actually balance gold with all your financial goals. We are not recommending that people invest all their money into gold, but we are recommending that you begin to allocate a significant portion of it, a portion that you will not touch over time, into gold, so that you actually get far more return on your money. Because one thing is certain, currency depreciation will actually happen. Inflation is going to be the rule of thumb. Economic uncertainty will definitely increase. All this insecurity will actually be a prevailing norm. All these factors are factors that you do not have control over, and this will keep happening. So the best way you can actually do this is by securing your financial portfolio with gold in a way that it will actually make you better and stronger over the day. Whether you're seeking to hedge against inflation or planning for major financial events like dollar cost averaging, using strategies such as diversification or milestone-based goals will give you the ability to achieve wealth building success with gold. Regularly reviewing and adjusting your goals as the market and your financial situation change will keep you on track for the future. And who is actually the company that is actually recommending you to do this? We are Dukia Gold, a leading gold and precious metals firm in Nigeria and West Africa, offering full service bullion solutions. We maintain a diverse client base, from investors to banks to corporate individuals, for actually helping them to build wealth with gold. We've created a platform whereby at the comfort of your home, you do not need to actually come, and at the comfort of your home, you can just pick up your phone, pick up your tablet, pick up your laptop, open an account, register, and buy gold automatically. You won't need any stress to do that. We've been featured everywhere, from Business Day to The Guardian, to Nigerian Investment Promotion Commission, to The Independent, SEC Africa, Market Forces. Everywhere we around you go, we have been keeping people updated with how to secure their investment benefits with gold. And most of our practices are actually guided by the London Bullion Market Association, ensuring that we incorporate regular audits, vigorous sourcing practices, transparent transaction processes in all our gold transactions. This is why when even you register on the platform, you have to actually complete a KYC. And most people actually feel offended, but actually doing a KYC when they register on the platform, but it actually gives you trust and credibility that in case there is a mishap, we actually can track all your transactions automatically within a second. So how do you create an account? You go to the new.dukia precious metals, enter your personal information, verify your KYC, and complete registration as soon as possible. Thank you so much, but I will invite Mrs. Adetutu Ijose, a business consultant based in the United States, to speak and guide us through the next session of this presentation. Ma, you have the floor.
Okay. Hello, can you hear me? Can everybody hear me? Hello?
We can hear you. We can hear you, ma.
Oh, you can hear me. Okay. I just wanted to check that. Okay, good day, everybody. My name is Miss Adetutu Ijose. No, but generally people call me Miss A because they find it difficult to pronounce my name. So I'm going to, and I just want to thank Dukia Gold for inviting me to be a speaker at this event. See, I'm going to share my 2 cents to help us in using the information provided by Emmanuel, which is very important, to diversify our investment portfolio, okay, by adding precious tangible assets, the one we call gold, that increases in value with time. We're going to be looking at the global economic outlook and gold's performance. Emmanuel, can you please give me my first slide?
Yeah, okay.
Hello?
Just give me a moment. Just give me a moment. Let me just share my screen. Just give me a moment.
And if it doesn't show up, anyway, it's not a fancy, it's not anything fancy, just some words.
Just give me a moment. Should share it. Mhm. Can you see my screen?
Oh yes, now I can see your screen.
Okay. Thank you.
Okay, let's start. The current global economic landscape is marked by complex, multifaceted uncertainty with trade tensions and interest rate fluctuations impacting markets. This has forced nations to go back in time to the store of value that has been from ancient times, indeed from the beginning. Gold has re-emerged as a safe haven asset, with prices surging to record highs. As of today, this morning, October 30th, 2025, the gold price is just shy of 4,000. We've been told that it went above, but the markets are now very volatile. In one day, you could have movements, of difference in prices, but it stayed stable above 3,900 for a while. In the 70s, when the US ditched its version of the gold standard, which it had established as an alternative to the traditional gold standard of that time, gold was $350. Why did it fail? Because the US was bankrupt. And as a way to show itself and avoid bankruptcy, it offered to replace gold as the full means of international trade of goods and services. This put a lot of pressure on the country as it had to make available the entire dollars needed for all trades of goods and services, including the exchanges, spot, futures, arbitrage, derivatives, and so on, and also national reserves and loans. Everything was dollarized. The full payment had to be in dollars. This restored and enhanced the value and trading price of the dollar, creating unprecedented levels of demand. This was the dollar standard, which the US had promised would be fully backed by gold. So nations and their central banks did not need to keep expensive gold reserves. Just get the dollar and you'll be covered, as the dollar was backed by gold. The US soon found itself unable to afford the gold needed to back all these transactions, and the system failed. And the US, when the price of gold hit 350, chose to begin printing paper currency with no gold backing without telling the nations. By the time the other nations found out, they were up to their necks in worthless dollar. The US had built its domineering war machinery, using it to destabilize any dissenting nation, while promising security cover to consenting ones. And the rest, as they say, is history, as everyone became poor in one day. The nations agreed to artificially shore up the dollar in self-interest to avoid declaring bankruptcy. They all looked the other way as the US drowned in debt, and the other nations soon followed this way of ballooning debt of worthless currencies. I'm just providing the statistics and story to show us the dicey times we are in. This is the time to diversify our portfolio. Now, let's look at the effect of World War II and the bailout of nations. Just consider this, that after the Second World War, it was the colonized African countries that bailed out their colonizers and everyone else. Indeed, colonization was not a result of economic superiority. In fact, the colonized nations had all the money. But well, we'll leave it at that, because if we're going outside our stated limits to go any further with the reason for colonization, suffice to say that it happened. So this economic dependency made the bailed out nations decide to find a way to keep the channel open after the countries became independent. Promises were made of assistance in quick nation building to bring the nations up to speed with others, without letting them realize that they had been built by pre-colonized African nations. Okay, so African nations trusted and accepted the transfer of rights to their resources. The promises were not kept, as the nations did not have the solutions promised. They therefore resorted to psychological marketing to create a narrative which, if African nations bought, would keep them subservient and provide the wealth the nations needed to survive. It was a temptation to African nations to think that self-building was unnecessary. That was an unnecessary reinvention of the wheel, as they say. Hence, at the beginning of it was the beginning of the reversal of a mindset, so that African nations lost their self-confidence, and though rich, started behaving poor, asking for handouts while selling their resources. They were trapped into loans in foreign currencies that had no value, falsely believing that there was a transfer of wealth to them. There was actually no transfer. No funds actually left the nations or foreign banks. It was all engineered. But African nations were given self-destroying conditions that had crippled other nations that tried them in earlier times. The perception-targeted marketing strategy worked, because perception is very important. It also resulted in today's huge debt balance that was needed to keep up the appearance of wealth. Then came more hard parts. The nations did not originate technology. They had been taught by pre-colonial Africa and people of African descent in those nations. Now they needed new technology and needed new brains from the African nations. In addition, the funds they were generating did not flow to the nations. The various corporations and individuals kept the money, creating huge wealth gaps in those nations they could not fix, forcing them to do more marketing to achieve the same thing in African nations, to continue the inferiority mindset and make the brightest leave home for so-called greener pastures, and so we say in Nigeria, Japa. Now that those strategies are beginning to fail and the old narratives no longer tenable, we have a scramble for gold to show up these nations to continue to try to maintain the old narrative, or at least try to avoid declaring bankruptcy. Now we have an understanding of today's world. It is not as simple as I have presented it. There are many powerful and result-determining factors in the code of natural and spiritual existence running behind the scenes, but we'll limit ourselves to the economic outcome. We will talk about the implication of all this for our investment portfolio. And Emmanuel has already, spoken a lot about that. And like he said, if nations, banks, and other corporations are diversifying, desperately scrambling for gold for survival, how should we position ourselves who have the opportunity to show up ourselves the easy way? We should diversify. Now, let's take a look at the advent of e-banks and e-currencies. If you don't know, it is now possible to borrow money from an e-bank and spend it online for crypto and other currencies, goods, and services without any real money changing hands. Consequently, fictitious wealth that can evaporate at any time is made up without the bank having any real deposit or a small fraction of what is being loaned out. So in today's world, the amount of made up wealth is thousands of times more than the real wealth. Okay, so we are an unprecedented level of global, national, corporate, and personal debt. Okay, it's extremely high. Now, Emmanuel, next slide, please. Now, let's look at the country economic and risk assessment. Based on the report in Gold We Trust and other sources, here are the economic and geopolitical highlights for the specified regions and countries. We're just going to look at a few. The US. The US Federal Reserve, has just cut interest rates, and there are plans to further cut the rates. There's great pressure from the system itself for rates to go down. Okay, the US dollar's value affects gold prices, and a weaker dollar can lead to higher gold prices. And though the US has significant gold reserves and its monetary policy decisions impacts the global gold market, it only has a tiny fraction of what it really needs to cover its debts, back its trade transactions, and keep a reserve. This makes the dollar extremely vulnerable, needing other avenues to keep it as a global currency. And then, so Q. Geopolitical and other methods are in play to keep it from collapsing as a global means of exchange in global trading. Okay, now let's look at China. China is one of the largest gold producing countries with significant gold reserves in a bid to avoid the debacle of the US. It, however, has the same debt issues. It cannot afford to cover the total of debt, trade transactions, reserve needs, and so on. It too is looking for ways to continue to be the global manufacturing center, without which it collapses as a global economic power. It has a population size that demands its continuation as the manufacturing hub to survive. And so consequently, the country's economic growth and monetary policy decisions can influence gold prices. So there's pressure everywhere. China's central bank has been increasing its gold reserves, signaling a strategic shift towards bolstering monetary resilience and reducing dependence on the US dollar. It has faced the reality that the status quo can collapse at any time without warning. The current situation may be the only warning that everybody gets before the implosion. And with its population, it does not have the luxury of doing nothing. So now let's jump over to Europe. The European Central Bank's monetary policy decisions can impact gold prices. They have been losing the blind loyalty of their former colonies. They have huge debts and can no longer rely on the cover of the US. It's now everyone for themselves. And they must shop their currencies to avoid collapse. So European countries consequently hold significant gold reserves, with some countries like Italy and France having large gold reserves trying to shop their currencies, so that even if they are unable to afford to go back to the traditional gold standard because of their huge debts, they can still survive. The European economy's performance can influence gold prices, particularly if there are concerns about economic stability, as it is beginning to happen, all over the world. Now, let's look at the United Kingdom. The UK's decision to leave the European Union, Brexit, has led to economic uncertainty, which can impact gold prices. And the Bank of England's monetary policy decisions can influence gold prices. And as part of its, everybody is being smart now. As part of its recalibration in a fast-changing world, things are changing very, very fast, and people have to think outside the box. The UK has transformed itself into a significant hub for gold trading and refining, making itself a major factor in the gold supply chain, hoping to prevent African nations from building up refining capacity. Okay? And this is working for now, but will probably change soon, like everything else. So everybody now has to strategize and think outside the box. Now, let's look at Argentina. Argentina has significant gold reserves, and its economic policies can impact gold prices. Consequently, we see the huge lobbying effort by the US to gain its unconditional loyalty. The country's economic instability and high inflation rates can lead to an increased demand for gold as a safe haven asset. Now let's come to Africa. Okay, this is why it gets interesting for us. Africa is a significant gold producing continent, with countries like Ghana, Mali, and South Africa being major producers. And many African countries are increasing their gold reserves to reduce dependence on foreign currencies and bolster economic stability. Indeed, gold mining is an important economic activity in many African countries, providing employment and revenue. And as we said a moment ago, African countries are beginning to wake up to the fact that they do not need external help in nation building and have all it takes to be self-reliant, that they are not poor, and that the narration of poverty is an attempt by others to stop themselves from imminent collapse by preying on them. So African nations, including Nigeria, are poised to change everything. Once their refining capacity is established, the rest will become history. The continent will then be the one determining the price of gold, amongst other things. So Emmanuel, what is my next slide? Next slide, please. Okay, so now we're going to specifically look at Nigeria, okay? Nigeria is increasing its gold reserves to boost its economy and reduce dependence on foreign currencies that it had been lured into like a spider's web. It is looking for the courage to take action, and the whole world is watching. Everybody is waiting for Nigeria, okay? The country has significant gold deposits, and its central bank is buying gold directly from local miners to capture more value at home. And Nigeria's decision to hold its foreign reserve in gold, which I personally think is one of the smartest things that has been done. That could help stabilize its currency and boost its economy. Okay, big time. Pre-colonial Nigeria, at that time, it was a different name. The same area mass, but a different name. It was the designer and major operator of the last real gold standard. It had a physical currency, the cowrie, backed by gold. Anyone who knows Nigerian, who knows the true history. Gold was also the instrument of conversion in barter trade, which most of the world was involved in then. It was the conversion mechanism for credit. This system depended on honesty. Gold was used to back shortfalls in the value of goods and services. This way, it was easy to keep all the gold needed for reserves and shortfalls. There were market exchanges and forward sales of goods, the currency for conversion and payments being the cowrie and gold. They were interchangeable. This is how the gold standard worked. It never failed. It was cancelled by colonization, and the British replaced the system with theirs, which failed. Now, let's look at the Nigerian economy and gold reserves. Nigeria is waking up to its potential as a global economic force. Everyone is waiting. There are many factors, physiological and spiritual, playing out, but we will stick to our limits of economic outcome for this seminar. That's all we're on a narrow path. Okay. Nigeria is leveraging its gold reserves to boost its economy. The country has initiated a national gold purchase program, which aims to increase foreign reserves and stabilize the naira. The program has already seen success with a $5 million increase in foreign reserves and the addition of 70 kilograms of gold refined to the London Bullion Market Gold Delivery Standard. And we've been told that come next year, we're going to have gold bullion available to purchase. Nigeria plans to hold its foreign reserves in gold, which is very smart as far as I'm concerned, to strengthen its currency and economy. I think that's one of the wisest decisions that, has been made. And now we look at the investment opportunities. That is the government that covers everyone. Now look at what people can do on their own. The Nigerian solid minerals sector is attracting significant investment, with over 1.3 billion invested in lithium processing since September 2023, so that we can all have our smartphones. The country's Minister of Solid Minerals Development, Dr. Dele Alake, has urged investors to increase their stakes in Nigeria's solid mineral sector, citing positive reforms and potential for high returns. Now, let's look at gold miners and the market trend. Gold miners are poised for bumper profits following the record rally in bullion price. Remember that Emmanuel told us about, stocks in gold producing companies and all that. And I think the chairman has told us, I think a few months prior, that Dukia Gold, would shortly, be on the stock exchange. So it will be possible to invest in Dukia. Analysts expect top miners like Newmont and Barrick to post significant profits, driven by stable production and contained cost pressures. The gold mining sector is likely to continue benefiting from the current market trends, with investors watching for updates on CEO changes and production levels. Okay, those are the things that, because the market is there, so now it will be a factor of corporate management. So now let's conclude. In conclusion, gold remains a vital asset in times of economic uncertainty. And it's been like that forever. This is not a new thing. This is how people have sorted themselves out from time. Okay? And Nigeria's decision to hold its foreign reserves in gold could potentially stabilize its currency and boost its economy. With significant investment opportunities in the solid mineral sector and a growing demand for gold, the outlook for gold prices and gold miners appears promising, because gold is natural. So it's a natural store of wealth. And so it doesn't change. And I hope that I have been able to bring a little bit more clarity, a little better understanding to whatever questions you may be having, because you really do need to have a conversation with yourself. So thank you for listening to me, everyone. And thank you for diversifying, because it takes a village. When we all diversify together, we are all stronger. Okay. So once again, thank you and have a blessed day.
Thank you so much, Ma, for sharing those insightful thoughts concerning gold portfolio and how the Nigerian economy can better benefit from investing in gold. Okay, this is now your time for questions and answers. So please, if you have any question, you can signify by raising up your hand or typing it in the chat, and I'll attend to it as soon as possible. If you have a question, please just let me know.
Again, I need to say very big thank you to you, Emmanuel, and Tutu. I'm very, very grateful for the wonderful insight. And I think in talking to you now, there are advantages, disadvantages, lessons to be learned, and everything. If you have questions, like Emmanuel says, please post it, and let me try and address, and then Emmanuel will also try and address as much as. I apologize for a bit of background noise on my side, but I'm sure you understand a bit. I don't have the ideal office situation right now. Two things I want to try and address first and foremost. Please, if you are going to buy gold, talk to your advisor. We are only here to show you many things, but I'm certain that you need to also speak to your advisor. So let me show you the chart for gold for the year. Emmanuel, please bring up the chart for gold for the last 365 days, if you don't mind, so that I can use it as a conversation point. So if you are lucky to have acquired gold early in the year when we said buy gold, buy gold, buy gold. Um, and yeah, okay. So thank you, Emmanuel. So this is technically a 1 year view of the price of gold. Take it to January, and you see the value of gold at the beginning of the year, right? And if you took it even 6 months before, you'll find that it was actually at a lower rate. But if you look at the totality of the sum of the triangle, like they say, it will give you a clear idea that depending on the day you invest, depending on the week you invest, depending on the period you invest, you can either say I've made gains and made losses. Like every good investment in this world, nobody controls it, only God does, but you have to also control it with a lot of information. The first thing we would know is that anyone who has been smart and has been buying gold every month, all through the 365 days since last year, or perhaps take the 270 days, which is what we are looking at now, would have an average cost of investment. If you do your average cost of investment, gold has had an elevated increase of almost 60% this year. And that's just looking at this year alone. Last year, confirmed, it made in Naira terms 112%. And there will be need to compare gold across other investments, whether treasury bills, whether guaranteed shareholding, whether commercial paper. Please, stay where you are. I mean, the graph is important. So that when you compare your investment, compare it relative to three things. Gold is not 100% of your investment, and we don't recommend it that it should be 100% of your investment. The best that will happen is gold will be just a percentage, maybe 10, maybe 20. Like I said, Demon says 25% now, which is quite strange from him, but it's to correct the fact that he had not exposed his own portfolio to gold, so he has to direct real raw cash to it now. But if you've been investing, you have that. The second is that gold is not for the average speculative trader. You can't trade gold as a end-end retail and expect to make a lot of margin. So I'll tell you the secret, for instance. If you don't have money for 1 kilogram, just like anybody who has ever bought and sold sugar, 1 packet of sugar. So when we were in secondary school, if you remember, you could bring a whole century packet to the to your school. If you are generous enough, you give it all out. Maybe then you then have pocket money for the week, and then for the very first time, you're going to have to cut that pocket money to many issues that you want to address. And it then turns out that that pocket money is just buying 5 cubes of sugar out of a whole packet of sugar. I can assure you the price that you pay for the packet of sugar, one whole century cap, is not the same price you will pay if you are just buying 5 cubes. Reason is simple. On the day that packet is opened, 5 is sold to you. That person who is holding the 96 cubes still needs to wait maybe now for another 40 people to come and buy. In the process, if it's left outside the rain and the sugar melts, it's not going to say to you that you are the one that caused her or him to open his packet, come and give me. So there are the holding cost and the transactional cost of cutting gold to 1 gram. Check any website anywhere in the world, 1 gram is going to be far more expensive than 1 kilogram. Far, far more expensive. Unfortunately, if you don't even have money for 1 gram and you say, okay, I want to attempt 1 ounce, of course, there will be opportunity also to take your cut and say, I bought 1 ounce, and you look at the price at they sell 1 ounce so-called LBMA price. That LBMA price, as you and I know, is available to volume buyers. What's a volume buyer? HSBC wants to buy gold for the Shanghai government, even though they will say is independent of the mainland, or they want to buy gold for substantial clients across the world in Asia. They buy serious volume. So the price that you see on that leaderboard is the price that is available to maybe 7 or 8 buyers in the world. And they know themselves. They actually call it the price fixing committee. And they are the ones who say, okay, at volume, maybe 1 million ounces a day, 2 million ounces, we will pay so much. The rest of us, including this midget called the Dukia Gold, needs to queue up on the value chain to get, and then you sell. We have an analogy, and that analogy is someone who buys and sells Coca-Cola. If you go to the Coca-Cola factory and you call yourself a main distributor, it's quite different from me and you who want to do a 4 to 6 party when we were young and say, Mommy, buy me 4 crates. And then you go up to Coca-Cola gate and say you want to buy the same 4 crates at the same price. Of course, if you take that, you will then have to wait properly. And like I said, overage your prices by buying on rainy days and not so rainy days. And you will then have whatever. Therefore, it's interesting when people then say, I've made money, I've not made money. Making money on an investment is a relative term. And I cannot but apologize to anyone who has a risk tolerance or people who don't have a risk tolerance or who have time tolerance and who don't have time tolerance. If you are going to get into gold as an investment, it has to be a long-term gold investment. The higher the volume you buy, the better the overaging price or the averaging price for you, depending on how you speak your English. But if you look at it on the short run and on the long run, and if you look at it from the portfolio of the persons that we are trading with, not just 1 or 2, 80% of all of us who have bought gold over the last 2 years when we started to try and trade gold have found that they have at least made an over 180 to 190% increase in the portfolio. We have in our midst today a 101-year-old gentleman who bought a bit of gold 3 years ago when we started. Gold then was $58. And today I can say to you, gold is far in excess of 100 and whatever it is. And you will say it's doubled his money. It's not only doubled his money because the price of gold went up. Exchange rate also was in his favor. And that's, for me, a plus. The second calculation that has also happened is we predicted that the Naira will farm up. And I'm happy that it has come from 1,800 to 1,500. And it's going to stay around 1,400 for a bit. And I'm happy that everybody has also listened to Dangote say that the Naira is going to fall. And it's going to really, really farm up by saying anyone whose stock is cashed in dollar needs to be careful because in the short run, the dollar is going to have to be made cheaper for the Americans to succeed in what they're trying to do with the rest of the world in terms of negotiation. And if that happens, and they are no longer piling our Naira to go and buy dollar for fuel because Dangote is really processing Nigerian crude and selling Nigerian crude in Naira, which is also what we are also saying. Very soon, Dukia Gold will be processing Nigerian gold and selling Nigerian gold to Nigerians. The price of the gold is going to get a lot better for all of us. And so the first thing I'll say is thank you for those who believed in us, despite the fact that they see the challenge of investing in gold, but it has returned, in our opinion. But what I can say is just like everybody used to shout, oh, you buy 1 liter of petrol at 2,000 in black market. We have taken gold away from the black market. That's number one. Second is, yes, we have tried to normalize the purchase of gold because we have to place at the international rate and international level, and that has happened. The last bit which I need to let you know is that if there is anybody who needs a master class, please, I would organize a master class again on how to buy and evaluate your gold. A few people are also misreading um, their portfolio properly and not very well informed. But I will close by saying the following. We would remain a fair trader at all times because that's who we are. We would continue to do everything in our best interest to make sure that everybody gets investment grade gold at the best price. And we'll continue to tell all of you, buy gold now because honestly, um, quote me, in a year's time, gold will be more than $6,000 an ounce. Uh, Whether you then say you've made a profit or not would only come if you invested well before it became $6,000. But if you have to wait until it's $5,900 and you buy on a day when it's almost 5,999, and some people took profit and the price went down, you're not patient enough to want to wait until the price goes back up, you will declare a loss. If you buy guaranteed trust bank shares, you will do the same. So it's a long-term investment. It's definitely made over 60% return. Read any currency, dollar, pound, euro in Nigeria is actually done a lot better because even though the naira is pumped up against the dollar, because gold has gone up by almost 80%, all our clients should have experienced a small issue. But if there's any client who still needs to be spoken to be educated, to be properly um, um, informed, we would continue to do so daily and monthly through this platform. My job again is to thank the two presenters for giving us a very difficult insight into gold. Like they say, what they don't teach you in Harvard is a lot, but what you can also learn by yourself, pre and post Harvard, is a lot more. I hope, Emmanuel, you are satisfied with the questions. And Tutu, I must thank you very much for the gentle way in which you have spoken to us. It's very typical of your name. Tutu means in English exactly what I just said. And I continue to pray to God that the uncommon insight you have on many difficult issues, God will continue to grant you that joy. Emmanuel, over to you. I will talk to everyone in rounding up about the Dukia Arenola project so that everybody again is informed about the state of affairs of what we're doing. Emmanuel, over to you.
Okay, thank you very much, sir, for answering the questions. I've imputed our email, so for other inquiries that we cannot actually state here, we'll just have our email and the website, so you can just reach us at any time you like. Or if need be, even if you reach us and it's something I cannot explain, I'll still definitely give you a call. So we'll just, I think I'll still call back the chairman to just introduce the Ariola Mining Mineral Resources Development Project to everyone who is interested. I know that we talked about this during the last period and a few of you reached out. So I'll just call him back to just lay emphasis on it so that we can round up as soon as possible. Thank you very much. Sir, you have the floor. Chairman, sir, you have the floor.
Oh, thank you. I sometimes forget that this machine requires for us to unmute. Again, I must thank you for that question. And the first thing I would like to first clarify is how much can you invest in gold? Honestly, we have Nigerians who have invested heavily in gold in the 70s. They bought gold at $35 an ounce. If you ask them today, where would they prefer their money? A house in Ikoyi or that same gold bar that is sitting in Switzerland? They would always tell you, of course, gold. And the question then you ask yourself is, if $35 bought 1 ounce, then how much is that 1 ounce today? Is what we are all arguing about making profit or not making profit out of. That ounce is being sold around $4,000, and that's what we're saying is going to increase eventually to $5,000, $6,000. So if you look at one commodity that does not require a plumber, that doesn't require an electrician to come and maintain, just put it away quietly. If you had kept the same value of dollar, you'd have kept $35. Even if you give yourself treasury bills and compounded interest on treasury bills, there is no way $35 invested in a treasury bill over the same period of time would yield $3,500 or $4,500 in valuation. It's almost impossible. And we've also seen people say there are startup companies that they have invested in and they have 10x, 20x, 100x. Truth be told, that 100x, if you convert it and normalize it into what they call the parity ratio, you will find that gold has also held its own. We've shown at many of our workshop conferences and seminars that gold has outperformed the S&P. Gold has outperformed virtually every stock exchange index in the world, including the Naira. Gold will always outperform the Nigerian bill because whatever happens, the Nigerian bill will not pay you 30%, and gold has returned 60%. And I'm not saying this